Ladies and gentlemen, there's a moment in every market cycle when the room changes temperature. You can feel it before you see it. Conversations get shorter. Eyes stop scanning for opportunity and start scanning for exits. And tonight, when we talk about the silver trade, we are standing inside one of those moments. Not because silver is shiny, not because it's industrial, not because it's historical, but because something far deeper is happening beneath the price, beneath the charts, beneath the headlines. Shorts are getting crushed, and the reason why matters far beyond silver itself. For years, silver was treated like an afterthought, the poor cousin of gold. A market where leverage felt safe, where paper promises multiplied faster than physical reality, where the assumption was simple: volatility could be sold, spikes could be faded, and price could always be leaned on. That belief became muscle memory. Funds built strategies around it, desks staffed risk models around it, careers quietly depended on it. And when a belief becomes comfortable, it also becomes dangerous, because markets don't break when people are wrong. They break when people are confidently wrong together. Silver is not just a commodity, it is a financial mirror. It reflects inflation fears, industrial demand, monetary trust, and most importantly, human behavior under pressure. For a long time, the paper market expanded faster than the physical market ever could. Contracts stacked on contracts, leverage on leverage, with the assumption that delivery would never truly be tested. That assumption worked until it didn't. And when physical demand stops being theoretical and starts showing up at the door, everything changes. Short sellers don't wake up trying to destroy markets. They wake up believing they're rational. They believe liquidity will save them. They believe volatility will revert. They believe someone else will sell first. And then one morning the screen turns against them. Margin requirements change, inventory tightens, and suddenly the trade that looked elegant becomes existential. That's when psychology takes over. That's when math gives way to fear. I've seen this pattern repeat across decades. It always starts quietly, a little stress in funding, a little hesitation in rolling contracts, a little bid that doesn't disappear as fast as it used to. Then comes the reflex. Shorts add, they press, they defend, and that's the fatal mistake, because when a crowded trade meets a structural shift, the exit is never wide enough. Silver is experiencing that shift because it sits at the intersection of two worlds colliding. On one side, industrial demand is not optional. It doesn't care about narratives. It cares about electrons moving, panels being built, technology scaling. On the other side, monetary trust is thinning. People don't say it loudly at first. They just act differently. They hedge, they diversify, they look for things that are not someone else's liability, and silver quietly, stubbornly fits that role. Shorts are getting crushed not because price is rising, but because assumptions are collapsing. The assumption that supply is endless, the assumption that leverage can always be rolled, the assumption that physical delivery is a footnote. When those assumptions fail, risk managers don't debate philosophy. They demand action. Positions get reduced not because traders want to, but because they have to. And forced buying is the most violent force in any market. I want you to understand something deeply human here. Behind every short position is a person with a thesis, a track record, a reputation, and a tolerance for pain. When price moves against them slowly, they can rationalize. When it accelerates, they negotiate with themselves. And when it gaps, they capitulate. That emotional arc is not weakness, it's biology. And markets exploit biology relentlessly. This is why squeezes don't announce themselves. They unfold while people argue about fundamentals. They intensify while analysts debate valuation. And by the time consensus forms, the damage is already done. In silver, the stress shows up in places most people don't look. Lease rates, delivery times, spreads, the subtle signals that say the paper claim is no longer equal to the physical thing. That's when shorts realize they're not just betting on price, they're betting on time. And time is the one thing markets can take away instantly. For the average investor, this story isn't about cheering for pain. It's about recognizing structure. Financial struggle is real. Inflation erodes quietly. Wages lag loudly. People feel it at the grocery store long before they see it in CPI reports. When trust in systems weakens, people don't need to understand futures curves to feel the shift. They just need to sense that something is off. And silver has a way of absorbing that unease, of translating it into demand that doesn't care about short-term narratives. What we are witnessing is not a rebellion against markets. It's a reminder of what markets are supposed to do. Price is truth over time. And when truth collides with leverage, leverage loses. Every time. Shorts are getting crushed because they leaned against a market that stopped behaving politely. A market that started asking harder questions. A market that demanded delivery, not promises. And here's the part that separates spectators from participants. This isn't just about silver, it's about how you think when consensus feels safe. It's about how you manage risk when comfort is highest. It's about understanding that the biggest opportunities and the biggest dangers live in the same place, widespread agreement. When everyone believes a market can't move, it's already moving. When everyone believes supply is abundant, it's already tightening. When everyone believes shorts are in control, control is already slipping. I've sat across from traders who were brilliant, disciplined, and absolutely certain, right up until the moment certainty failed them. Markets don't reward intelligence alone. They reward humility. They reward flexibility. They reward the ability to say, the world has changed and I need to change with it. Shorts and silver are learning that lesson the hard way, not because they lacked skill, but because they trusted yesterday's map in today's terrain. As we stand here, the most important takeaway is not to chase, not to gloat, not to panic, but to listen. Listen to what the market is whispering before it starts shouting. Listen to where stress is building. Listen to where leverage feels too comfortable. Because the future never arrives with a drum roll. It arrives disguised as a small inconsistency that everyone else ignores. Silver is reminding us that real assets still matter, that structure still matters, that psychology still rules. And for those willing to pay attention, this moment isn't frightening, it's clarifying. It tells us that even in a world of algorithms and abstractions, reality still has weight. And when reality asserts itself, no position, no matter how crowded, no matter how confident, is immune. Thank you, and if you listen closely, you'll hear something else beneath the noise, something almost uncomfortable in its honesty. You'll hear the sound of systems straining under their own complexity. You'll hear the tension between what is promised and what can actually be delivered. That tension is where markets reset themselves, not gently, but decisively. Silver happens to be the stage right now, but the play is much bigger. Think about how this started. Years of suppressed volatility taught participants that risk could be engineered away, that leverage could be layered without consequence, that central backstops, liquidity injections, and policy responses would always arrive on time. That belief didn't just shape trades, it shaped behavior. It made caution feel outdated and conviction feel optional. And then reality did what it always does. It reasserted itself without asking permission. In moments like these, the market stops rewarding cleverness and starts rewarding alignment with truth. Shorts feel the pressure first because they are structurally fighting momentum when momentum is being driven by necessity, not speculation. When fabricators need metal, when inventories thin, when delivery windows stretch, price stops being an opinion and becomes a signal, and signals don't negotiate. There's a quiet cruelty in how this unfolds. Losses compound fastest when pride delays action. A short position that should have been a trade becomes a statement. A statement becomes an identity. An identity is the hardest thing to unwind. That's why squeezes feel personal. They expose the emotional scaffolding behind financial decisions. They remind us that no model can fully account for fear, and no spreadsheet can quantify relief. For those watching from the outside, maybe feeling battered by years of uncertainty, this moment carries a different kind of resonance. It says that imbalance doesn't last forever, that distortions, no matter how institutionalized, eventually confront limits. That patience, often mocked in fast markets, still has power, and that resilience, financial and emotional, is built by understanding cycles, not chasing headlines. The silver trade is teaching a brutal but necessary lesson. Markets don't exist to validate our narratives. They exist to test them. When too many participants rely on the same assumption, the market's job is to challenge it. Shorts are getting crushed because the challenge arrived faster and harder than expected, and because the exit required collective humility in a space where individual confidence had been rewarded for too long. What matters now is not predicting the next tick, but internalizing the shift. Recognizing that scarcity, once revealed, cannot be unseen. That trust, once questioned, does not return easily. And that when financial structures are stretched thin, the snapback is rarely polite. It's decisive, memorable, and transformative. This is how markets cleanse themselves. Not through theory, but through consequence. And while the pain is real for those caught on the wrong side, the clarity that follows is invaluable for everyone else. It reminds us why discipline matters, why risk is not a line item but a lived experience, why humility is not weakness but armor. So as this story continues to unfold, don't just watch the price, watch the behavior. Watch how quickly certainty evaporates. Watch how narratives change after losses crystallize. And remember that every cycle leaves behind a lesson for those willing to see it. Reality always wins, leverage always tells the truth eventually, and markets at their core are still profoundly human. And when you truly absorb that, something shifts inside you as well. You stop looking at markets as puzzles to be solved and start seeing them as living systems to be respected. You recognize that price is not just information, it's consequence. That volatility is not chaos, it's communication. And that when a market like silver starts speaking louder, it's because it has been ignored for far too long. There's a reason silver has always unsettled people in power. It's small enough to be underestimated and important enough to matter. It sits quietly between industry and money, between utility and trust. When confidence is high, it's forgotten. When confidence erodes, it's rediscovered with urgency. That rediscovery is rarely smooth. It's abrupt, it's emotional, and it's unforgiving to those positioned on the wrong side of necessity. Shorts are learning that the hard way because necessity doesn't care about timing models. It doesn't care about quarterly rebalancing. It doesn't care about consensus targets. When physical demand meets constrained supply, the market stops asking permission. And when leverage is stacked against that reality, the unwind becomes a chain reaction. One margin call begets another. One forced buy lifts the next offer. And suddenly the very act of trying to escape becomes the fuel that drives price higher. This is where spectators often misunderstand what they're seeing. They call it manipulation. They call it irrational. They call it temporary. But what they're really witnessing is accountability. Accountability for years of assumptions that went unchallenged because they were profitable. Accountability for confusing liquidity with abundance. Accountability for believing that something essential could remain permanently cheap without consequence. And there's something deeply human in watching that accountability unfold, because everyone in this room knows what it feels like to ignore a problem that grows quietly in the background. Everyone knows the temptation to believe that tomorrow will look like yesterday because yesterday was survivable. Markets behave the same way people do. They postpone reckoning until they can't, and when the reckoning arrives, it doesn't arrive gently. Yet inside that discomfort is opportunity. Not the shallow kind that chases headlines, but the profound kind that reshapes perspective, the kind that teaches you to ask better questions. Not how high can this go, but what assumptions am I relying on that no longer hold? Not who's right, but what has structurally changed. Those questions don't just make you a better investor, they make you a calmer one. Silver's message right now is not about prediction, it's about awareness. It's about understanding that fragility hides in places that look stable, that pressure builds where complacency lives, and that when too many people believe risk is contained, risk is usually migrating somewhere unseen. Shorts are getting crushed because they stood where risk had been quietly accumulating for years. As this cycle continues, some will focus on the drama, on the headlines, on the daily moves. Others will quietly recalibrate how they think about value, scarcity, and trust. They'll recognize that wealth is not built by forcing the market to agree with you, but by positioning yourself so you don't need it to. They'll understand that endurance matters more than brilliance, and alignment matters more than conviction. And that's the deeper gift of moments like this. They strip away illusion. They remind us that markets are not machines to be gamed indefinitely, but ecosystems that eventually rebalance. They humble the overconfident and steady the patient. They reward those who respect reality and punish those who try to bend it for too long. And clarity, once earned, changes how you hear everything else. You start noticing the pauses in official language, the careful phrasing, the confidence that feels slightly rehearsed. You notice when explanations arrive faster than facts. You notice when markets are being reassured instead of informed. Those subtleties matter because they're often the earliest signals that stress is no longer theoretical. Silver is amplifying those signals. Not loudly at first, but persistently. It's exposing how thin the margin for error has become in a system built on rollover, rehypothecation, and the assumption that settlement is a formality. Shorts feel this acutely because their position depends on continuity, on nothing interrupting the chain, but chains don't fail at their strongest link. They fail where strain has been ignored the longest. What's unfolding now is not a sudden event. It's a delayed response to years of monetary expansion, to distorted price discovery, to the quiet transfer of risk from balance sheets that could bear it to structures that assumed they never would have to. When that risk resurfaces, it doesn't knock, it arrives. And silver once again is acting as a pressure valve. There's an emotional honesty to this moment that's hard to ignore. People who've spent years feeling behind, confused, or gaslit by markets that didn't seem to reflect real life are watching something finally make sense. They may not articulate it in technical terms, but they feel the alignment. They feel that something real is asserting itself over something abstract. That feeling is powerful and markets respond to it. For shorts, the realization is brutal because it forces a confrontation not just with price but with worldview. It forces the question of whether the system they trusted is as resilient as they believed, whether liquidity is as infinite as it appeared, whether control was ever as firm as it felt. And when those questions surface simultaneously across desks and institutions, behavior changes fast. This is where history quietly rhymes. Every era believes it has mastered risk. Every generation believes its tools are superior. And every cycle eventually reminds us that leverage amplifies error just as efficiently as it amplifies success. Silver doesn't care which generation is learning the lesson. It delivers it all the same. What separates those who endure from those who don't is not foresight, but response. The ability to adapt without panic. The ability to respect what the market is revealing instead of arguing with it. The ability to step back and recognize that survival is a strategy, not a consolation prize. Shorts who escape with discipline will remember this moment. Shorts who don't will redefine it for everyone else. And for those building their own path forward, this is a reminder that the most important capital you manage is not financial, it's psychological. It's the ability to remain steady when narratives fracture, to remain curious when certainty collapses, to remain grounded when the crowd swings from complacency to fear. Silver is doing what it has always done at turning points, forcing honesty, about supply, about trust, about limits. Shorts are getting crushed because honesty is expensive when you've been betting on denial, but out of that cost comes a recalibration that makes the next chapter possible. And when this chapter is eventually written, it won't be remembered for a single price level or a single headline. It will be remembered as a moment when the market reminded everyone, quietly at first, then unmistakably, that reality cannot be shorted forever. And that realization lingers long after the screens go dark. It lingers in how portfolios are rebalanced, in how risk meetings sound different, in how silence replaces bravado when assumptions are no longer safe to say out loud. Because once a market exposes a fault line, no one truly forgets where it is. They may step back over it when calm returns, but they never stand on it the same way again. What's especially striking about silver is how little spectacle it needs to make its point. There's no grand announcement, no coordinated alarm, just persistence, just bids that don't vanish, just supply that doesn't arrive on schedule, just stress that refuses to dissipate. And for shorts, that kind of pressure is the most exhausting of all. It denies them the relief of resolution. It forces them to live inside uncertainty, day after day, while capital is tied up and patience erodes. This is where markets test character as much as capital, because the temptation is always to wait for validation, to wait for the crowd to agree, to wait for the narrative to flip so exiting feels justified. But markets don't grant emotional closure, they only offer prices. And when those prices demand humility, the only real choice is whether to pay early or pay later. Silver's role in this moment is almost surgical. It's not trying to dominate the conversation, it's exposing the weak points in it. It's showing how quickly confidence built on abstraction dissolves when confronted with physical reality. It's reminding everyone that at the end of every contract, every model, every elegant theory, there is a simple question. Can it be delivered? For years, that question felt academic. Now it's operational. And operational questions don't tolerate ambiguity. They require action. They require inventory. They require honesty. Shorts are getting crushed because honesty arrived faster than expected, and leverage had nowhere to hide when it did. There's a quiet dignity in recognizing this without needing to dramatize it. The goal isn't to celebrate losses or to crown heroes. The goal is to understand the mechanics of inevitability, to see how systems drift away from balance and how they snap back, to internalize that markets are not moral, but they are consistent. They don't punish intent. They punish misalignment. And for anyone listening who has felt outmatched by complexity, overwhelmed by jargon, or sidelined by speed, this moment carries a different lesson. You don't need to outsmart the market to survive it. You need to respect it. You need to understand where reality exerts pressure and where stories fill the gaps. You need to recognize when patience is strength and when stubbornness is fragility. Silver is not offering certainty, it's offering a signal that leverage has limits, that confidence can decay, that scarcity, once acknowledged, reshapes behavior faster than any policy ever could. Shorts are getting crushed because they stood on the wrong side of that signal for too long, trusting continuity in a moment that demanded adaptation. And as this pressure works its way through the system, something healthier begins to emerge. Price discovery regains meaning, risk gets repriced honestly, and participants, humbled or strengthened by the experience, carry forward a deeper respect for how quickly conditions can change. That respect is the real asset born in moments like this. It doesn't show up on a balance sheet, but it informs every decision that follows. It tempers greed, it sharpens awareness. It keeps you from confusing comfort with safety ever again. So when you think about silver, don't think about it as a trade alone. Think of it as a message written in volatility and patience. A message that says reality is patient, leverage is not, and markets always eventually find the truth. And when that truth surfaces, it doesn't ask who deserves it. It doesn't care who believed hardest or modeled best. It simply arrives, indifferent and precise. That's why moments like this feel so sobering to those inside the trade, because they realize often too late that the market was never arguing with them. It was waiting for inventory to matter again, waiting for timing risk to stop being theoretical, waiting for the gap between promise and possession to become visible, and once visible, irreversible. Silver didn't change its nature. The environment around it did. The tolerance for illusion narrowed, the margin for error vanished, and shorts, positioned for a world that no longer exists, found themselves negotiating with a reality that doesn't negotiate back. This is how confidence drains out of a system, not all at once, but through 1,000 small acknowledgments that something fundamental has shifted. Phones ring more often, risk limits tighten quietly, language becomes cautious, and beneath it all, there's an unspoken understanding that some trades are no longer trades. They are liabilities waiting to be recognized. What's powerful about this moment is how clean the lesson is. No ideology, no politics, just cause and effect. When supply is stretched and demand becomes non-discretionary, price stops being a debate, it becomes a referee, and the referee doesn't care who's been winning so far. It enforces the rules evenly, even when the outcome feels unfair. Silver enforces those rules with remarkable consistency. It doesn't spike for attention, it grinds, it pressures, it exposes. And that slow pressure is exactly what makes short positions so vulnerable, because hope can survive a spike, it rarely survives a grind. Day after day, the trade asks the same question. Are you willing to keep paying to be wrong? And eventually the answer changes. This is where markets reveal their deepest truth. They are not moved by intelligence alone, but by endurance, not by certainty, but by adaptability. The winners are not those who predict perfectly, but those who can change without breaking. Shorts getting crushed in silver are not villains in this story. They are reminders of what happens when conviction outpaces flexibility. And for everyone else, investors, builders, thinkers, people simply trying to protect what they've earned, this moment offers something rare: alignment. Alignment between what feels real and what is finally being priced, between lived experience and market expression, between patience and outcome. That alignment doesn't last forever, but when it appears, it's unmistakable. So as this pressure continues to work through the system, remember what you're really witnessing. Not a spectacle, not a rebellion, but a reckoning that was always scheduled, just delayed. A reminder that leverage borrows time and time eventually demands repayment. A reminder that markets, stripped of narrative, still obey the oldest rules there are. And if you carry that understanding forward, quietly, steadily, it will serve you far beyond silver. It will change how you measure risk, how you respect scarcity, how you respond when the crowd feels most comfortable. Because once you've seen a market stop pretending, you never confuse stability with permanence again.